Tonight, somewhere, a newsreader is going to say a sentence to you, "The market was up today," or "The market was down today." And you will nod the way everyone nods because you already know what that means. But stop for a second and actually look at that sentence. Which market? Up by what? Measured against what? Here is the answer, and it is stranger than you think. The number behind that sentence, the one that decides whether the whole world had a good day or a bad day, was invented by a newspaper reporter who was not an investor, who never managed a dollar of anyone else's money, and who built it for a completely selfish reason. He could not write his own stories without it. He added up the price of 12 companies. He divided by 12. That was it. That was the whole invention. And there is a second thing, and this is the part that almost nobody says out loud. There is a famous theory that carries this man's name. It is taught in trading courses. It is in the textbooks. It has 6 principles, and people argue about them the way people argue about scripture. He never wrote it. He never wrote a word of it. He died before it existed. The book with his name on the spine was assembled by 3 other men, the last of them working 30 years after Dow was in the ground. So in the next half hour, I want to give you 2 things. First, where the number you hear every single night actually came from, and why it is built in a way that quietly distorts what you see. And second, how a man's name ends up on an idea he never got to approve. Because once you have seen how that happens, you start noticing it everywhere. This is the story of Charles Dow, the reporter who built the ruler and never got to see what people would do with it. Charles Henry Dow was born in 1851 in Sterling, Connecticut, farm country. His father died when Charles was 6 years old, and that single fact shaped everything that came after, because it meant there was no comfortable path laid out for him. There was no family firm. There was no inheritance waiting. What there was work. And at some point in his 20s, Dow found the thing he was actually good at, which was asking questions and writing down the answers clearly. He became a reporter. He worked in Springfield. He worked at the Providence Journal in Rhode Island. And this is the detail I want you to hold on to because it explains the man completely. Dow was not a market person who drifted into writing. He was a writer, a working newspaper man who drifted into markets. That difference matters more than anything else in this episode. In 1879, there was a trip that changed the direction of his life. Dow traveled west to Leadville, Colorado, in the middle of a silver mining boom. He went as a journalist, embedded with a group of businessmen and bankers going to look at the mines. And what he saw there was not just silver. What he saw was how money actually got raised and how information actually moved. He watched men make enormous decisions on the basis of rumor, on the basis of who they had drunk with the night before, on the basis of a letter that arrived 4 days late. He came back east with a specific idea in his head, not a trading strategy, a journalism idea. The ideal was this: the financial world was starving for facts, and it was being fed gossip instead. Because you have to understand what Wall Street reporting looked like in 1880. There was no requirement that a company tell you what it earned. There was no standard for how it told you. Prices moved, and nobody could reliably say why, and into that vacuum poured the tip sheets, little papers, often paid for quietly by the very people whose stocks they were promoting. If you wanted to know what was happening, you did not read. You knew somebody. And if you did not know somebody, you were the person the somebody sold to. Dow moved to New York in 1880 and took a job reporting on the mining and financial beat. And almost immediately, he ran into the problem that would define his career and eventually give us the number you hear every night. He could not answer the simplest question his readers asked him. They would ask, "How are stocks doing?" Not this stock, not that stock. Stocks, the whole thing. And Dow, an honest reporter with a notebook full of individual prices, had nothing to give them but a list. Western Union was up. Delaware and Hudson was down. Union Pacific barely moved. That is not an answer. That is raw material pretending to be an answer. And Dow knew it. He was trying to describe a forest, and all anyone had ever given him was a bag of individual trees. In 1882, Charles Dow did something that reporters almost never do. He quit and he started his own thing. He went into business with 2 other men, Edward Jones, another newspaper man, a fast, sharp, sociable operator who could read a balance sheet quickly and could get people talking, and Charles Bergstresser, who is the forgotten one of the 3, and probably should not be, because he was the one with the connections and, by several accounts, the one who put in a good deal of the money. They set up at 15 Wall Street, in a basement, next door to the entrance of the stock exchange, Dow Jones Company. The name has 2 of the 3 founders in it, which tells you something about how Bergstresser was treated, and something about the fact that the name simply sounded better with 2. Now, what did this company actually do at the start? It is not what you would guess. They were not publishing a newspaper. They were running essentially a news wire made of paper and legs. Reporters would gather scraps of financial news through the day. Back at the basement, those scraps were written up. And then boys would run handwritten bulletins, flimsies they were called, because of the thin paper and the carbon copies, around the financial district to subscribing banks and brokerages. It was, in a real sense, a live feed. It was just built out of teenagers running through Manhattan. At the end of each day, the accumulated news was pulled together into a summary sheet called the Customer's Afternoon Letter. 2 pages. A digest of what had actually happened for people who needed to know before tomorrow. And this is the thing that grew. Because it turned out there was enormous demand for a source that was not being paid under the table to say nice things. Dow's own standard was strict, and by the standards of financial journalism at the time, it was close to radical. Publish what you can verify. Attach the source. If the company will not tell you, print that the company will not tell you. That last one sounds small. It was not. In an era where silence was the norm, treating silence itself as reportable information changed the incentives. Suddenly not answering had a cost. In 1889, the Customer's Afternoon Letter was renamed and expanded into a proper newspaper. They called it the Wall Street Journal. Charles Dow was its first editor. So before we get anywhere near the index, understand what this man had already built. He had built the institution that made financial facts public and comparable. The index is going to come out of that project. It is not a separate ambition. It is the same ambition taken one step further. He had spent 7 years making individual facts trustworthy. Now he wanted to make them add up to something. Dow's first attempt came in 1884. He took 11 companies, and he did the simplest thing a person can do with 11 numbers. He added the closing prices together, and he divided by 11. One number, published in the Customer's Afternoon Letter. 9 of those 11 were railroads. That is not a flaw in his thinking. That is an accurate photograph of what the American stock market was in 1884. If you wanted to own a piece of the American economy through the exchange, mostly what was on offer was track. Railroads were the technology story, the infrastructure story, and the speculation story, all at once. They were where the capital was. But over the next decade, Dow watched something happen that no single stock price would have shown him. The country was changing shape. Sugar, tobacco, leather, cotton oil, rubber, lead. Companies that made things and sold things were becoming large enough and publicly traded enough to matter. The railroads were how the country moved. These new companies were what it was becoming, and Dow understood that if he kept measuring only railroads, his ruler would go on quietly measuring the past. So on the 26th of May, 1896, the Wall Street Journal published something new, a separate average built only from industrial companies, 12 of them. They added the prices, they divided by 12. The number that came out was 40.94. 40.94. That is where it starts. That is the seed of the number that leads your evening news more than a century later. 12 prices, 1 division, and a decision about which 12. And I want to be careful here, because this is exactly the kind of number people love to dress up. I am not going to tell you what 40.94 is worth in today's money. That conversion is a trick. It makes a number feel meaningful when all it really tells you is how the arithmetic was set up. What matters is not the size of the number. What matters is that from that day forward, there was a single line that could be tracked day after day and compared with itself. Before it, how are stocks doing was a matter of opinion. After it, it was a matter of subtraction. Now, those original 12, American cotton oil, American sugar, American tobacco, Chicago gas, distilling and cattle feeding, General Electric, Lockheed Gas, National Lead, North American, Tennessee Coal and Iron, U.S. Leather Preferred, United States Rubber, Read that list again and listen to what it is telling you. That is the industrial base of a country in 1896. Sugar, tobacco, leather, lead, cattle feed, gas. And here is the fact that does the work of an entire lecture on its own. Of those 12 original companies, exactly one was still in the average by the modern era, General Electric. And in 2018, General Electric was removed too. The index is not the companies. The companies all left. The index outlived every single one of them. That is the strangest property of the thing Dow built. He created a container, and the container turned out to be more permanent than anything he put in it. Now, let me show you the part that almost nobody explains, and that quietly shapes what you see every night. The Dow is a price-weighted average. Add the share prices, divide. That sounds neutral. It is not neutral at all. It means a company's influence over the number depends on its share price, not on how big the company is. Think about what that means. Imagine two companies. One is enormous. Millions of people work there, it earns billions, and its shares trade at $50 each because at some point it split them. The other is a fraction of the size, but its shares trade at $500 each because it never split them. In a price-weighted average, the smaller company moves the index 10 times as hard. 10 times. On the basis of nothing but a decision about how to slice the ownership. A share price is not a measure of a company's size. It is a measure of size divided by the number of slices, and the number of slices is essentially arbitrary. A board can double it on a Tuesday afternoon. Nothing about the business changes, but its power over the Dow gets cut in half. This is why almost every index built since does it differently, weighting by the total market value of the company instead, so that bigger companies count for more, which is what most people assume is happening anyway. So why did Dow do it this way? Because in 1896, it was the only thing that was actually possible. He had share prices. He had them daily, reliably in the paper. What he did not have was a reliable, current, published count of how many shares each company had outstanding. There was no requirement to report it consistently and no fast way to collect it. To weight by company size, he would have needed data that did not exist in any usable form. Dow was not choosing the elegant method over the crude one. He was choosing the method he could actually execute every single day before the paper went out. And a measurement you can genuinely take every day beats a better measurement you can only take sometimes. There is a second piece of arithmetic that got added later, and it is worth understanding because it is where the average stops being a simple average. The problem is splits. If a company in the index splits its shares 2-for-1, the price halves overnight. Nothing has happened to the company. But if you just add and divide, your index falls off a cliff for no reason. So the divisor stopped being the number of companies. It became an adjustable figure, changed every time a stock splits or a company is swapped in or out, specifically so the index does not jump on days when nothing real occurred. Which means the modern Dow is not the sum of 30 prices divided by 30. It is the sum of 30 prices divided by a maintained number that exists purely to keep the line continuous across all its own edits. This is a real thing worth sitting with. The oldest, most quoted measure of the American market is a running total that has been carefully patched again and again so that it can appear to be the same measurement it was in 1896, even though every company in it has been replaced, and the arithmetic underneath has been repeatedly rewritten. It is less like a ruler than like a ship that has had every plank replaced and still answers to the same name. And the container kept growing. 12 companies in 1896, 20 by 1916, 30 by 1928, and it has stayed at 30 ever since for almost 100 years, through every transformation the American economy has been through. Think about that number for a moment. 30. There are thousands of publicly traded American companies. The most quoted measure of the market looks at 30 of them, chosen by a committee with no formula deciding who is in and who is out. It is a curated list, a judgment call made by people about which 30 companies best represent a country at a given moment. That is not a criticism. Somebody has to decide, and a committee that can use judgment will catch a shift in the economy faster than a rigid rule would. But it is worth knowing because it is so different from what most people picture. When you hear the Dow, you are not hearing the market taking its own temperature. You are hearing 30 selected companies, price-weighted, tracked through a divisor built to hide the seams. Charles Dow picked 12, because 12 was what he could gather. Every choice since has been someone else's, made for their own reasons, under his name. That is going to turn out to be the pattern of this entire episode. So the index exists. It is running. And now Charles Dow starts doing the thing that will get his name attached to something he did not build. Between about 1900 and 1902, in the last years of his life, Dow wrote a series of editorials in the Wall Street Journal about what he was seeing in his own numbers. Understand the format, because the format is the whole point. These were editorials, newspaper columns, written to a deadline, one at a time, thinking out loud in public, over a couple of years. They were not a system. There was no numbered list. There was no book. There was not even a single article where he laid out a complete method and said, here it is, this is my theory of the market. What was in them was a set of observations, and I want to give you them fairly because they are genuinely good observations and they are the reason all of this happened. The first is the idea of movements of different sizes happening at the same time. Dow described the market as having a long primary movement lasting a year or more, shorter secondary movements running against it, and daily fluctuation that is mostly noise. His point was practical. If you cannot tell which of those you are looking at, you will mistake a pause for a reversal. The second is confirmation. Dow now had two averages, the industrials and the railroads, and he observed that when one made a new extreme and the other did not follow, the move was less trustworthy than when both moved together. His reasoning was economic, not mystical. The companies that make goods and the companies that carry goods are describing the same economy, and if they disagree, one of them is probably wrong. The third is that volume and price should be read together, and that a move on thin trading says less than the same move on heavy trading. And the fourth, which is the one I find most interesting, is that the averages contain everything anyone knows. Every hope, every fear, every private piece of information held by every participant is already expressed in the price, because holding an opinion and acting on it is the same act in a market. Now, read those four again. They are careful, they are hedged, and they are the writing of a man describing what he has noticed, not a man issuing rules. Dow's own tone was constantly qualified. He wrote about tendencies, he wrote about what usually happens, he was, above all, a reporter, and reporters describe. He never called any of it a theory. He never called it Dow theory. He would have found that faintly ridiculous, I suspect, given that his entire professional identity was built on not overstating what the evidence showed. And then, in 1902, Charles Dow died. He was 51 years old. He had sold his interest in the company shortly before. He left behind a newspaper, two averages, and a scattering of newspaper columns that he never collected, never organized, and never had the chance to revise. That is the whole estate. That is everything he actually left. Here is where the story turns, and this is the part I really want you to have. In 1902, the same year Dow died, a financial writer named S.A. Nelson wanted to publish a book on speculation. He admired Dow's editorials. He wanted to include them. So, he gathered up the columns, reprinted a set of them inside his book, The ABC of Stock Speculation, and, in summarizing the ideas of a man who was no longer alive to object, he used a phrase, Dow's theory. That is the birth, not a discovery, not a manifesto, an editorial decision by a different writer about what to call somebody else's newspaper columns after he was dead. Then comes the second man, and he is the one who really built the thing. William Peter Hamilton had worked with Dow. He became editor of the Wall Street Journal, and from 1903 until his death in 1929, he wrote about these ideas over and over in editorials, applying them to live markets, arguing with critics, refining as he went, somewhere in the region of 250 articles across a quarter of a century. In 1922, he published a book of his own, The Stock Market Barometer. Now, be precise about what happened there. 26 years of one man's thinking, published under the authority of Dow's name and Dow's newspaper. Hamilton was not transcribing Dow. He was developing, extending, and in places deciding, filling in the enormous gaps a handful of editorials necessarily left. Every judgment call in those gaps was Hamilton's, and every one of them went out under a dead man's name, then the third man, Robert Rhea. Rhea was an invalid, largely bedridden, who studied these markets intensively. In 1932, he published The Dow Theory, and this is the book that fixed it. Rhea took Dow's editorials and Hamilton's 26 years of commentary, and he did the thing neither of the others had done. He organized it. He formalized it. He turned 3 decades of scattered observation into a structured doctrine with numbered principles that a reader could learn, apply, and quote. 1932. Charles Dow had been dead for 30 years. Let that land properly. The canonical statement of Dow theory. The version that goes into the textbooks, the version taught in trading courses today, the numbered tenets was written by a man Charles Dow never met 30 years after Dow's death, based partly on Dow's columns and substantially on a third man's quarter century of interpretation. So when someone tells you that Dow said the market has 3 movements, Dow did write about that, fair enough. But when someone recites 6 numbered principles of Dow theory as though they came down complete from the man himself, what they are actually reciting is Rhea's 1932 organization of Hamilton's interpretation of Dow's editorials. 3 authors, 1 name on the door. And I want to be honest about the other half of this, because it would be cheap to make Nelson, Hamilton, and Rhea sound like thieves. They were not. They credited Dow constantly and generously. They believed, sincerely, that they were preserving and clarifying the work of a man they admired. That is exactly what makes it interesting. Nobody had to lie. Nobody had to steal. Admiration alone was enough to build a doctrine and put someone else's name on it. The mechanism is simply this. A respected person makes some careful observations and then dies. Their carefulness dies with them because a dead author cannot say, "That is not quite what I meant." And each person who comes after, honestly trying to be faithful, has to make choices in the gaps, and every choice hardens. Hedges become claims. Observations become principles. Principles get numbered. And what does the research say about whether the resulting doctrine actually works? Genuinely, it is contested. Serious academic work has been done on it, and the findings do not agree with each other. They vary by the period tested, by the market, and by how you translate a set of qualitative principles into a mechanical rule you can actually test. Anyone who quotes you a single confident number for how Dow theory performs is telling you more about their sources than about the market. Which, if you think about it, is precisely the kind of overreach the actual Charles Dow spent his career refusing to commit. But there is one more thing about William Peter Hamilton that I cannot leave out, because it is the single event that made all of this famous, and it happened in the last weeks of his life. Set the scene. 1929. The American market has been rising for years, and by that autumn, the rise has taken on the quality that these things always take on near the end. Ordinary people are in it. People are borrowing to be in it. And the respectable opinion from economists and bankers and the sort of men who are quoted approvingly is that this is fine. This is the new normal. The old rules have been suspended. Hamilton was 72 years old, still editing the Wall Street Journal, still applying the framework he had spent 26 years building on Dow's editorials. And what the framework was telling him was the opposite of what everyone else was saying. The industrial average had peaked in early September. Then it had fallen. And crucially, this is the confirmation principle we talked about. The one Dow drew from having 2 averages, the railroad average was not holding either. Both were breaking down together. Under the framework, that is not noise. That is the primary movement changing direction. On the 25th of October 1929, Hamilton published an editorial. He called it "A Turn in the Tide." He wrote that the long upward movement was over, that the bull market had ended. 4 days later, the market experienced the worst days in its history. Now, I want to handle this very carefully because this single editorial is why Dow theory became a household phrase. And it is also the most misused fact in the entire field. Here is what is true. Hamilton did publish that editorial on that date, and the crash did follow immediately. That is documented in print with a date on it. Here is what is also true and gets left out. Hamilton had turned bearish and then walked it back more than once in the preceding years. He was not a man with one perfect prediction. He was a man who had been running the same framework in public for a quarter of a century, with the mixed record that implies. Scholars have gone back and studied his editorials as a body of work, precisely because he left such a long and dated public trail. And what they find is argued over to this day. And here is the part that always gets me. William Peter Hamilton did not live to see any of what came next. He died on the 9th of December, 1929, about 6 weeks after that editorial. So consider the sequence. Dow died in 1902 before anyone called it a theory. Hamilton died in 1929, weeks after the call that made the theory famous, and years before the Depression revealed how deep that turn actually went. Both of the men whose names are attached to this idea were dead before it became the thing people now argue about. It was left to Robert Rea in 1932, sitting in a sickbed in Colorado in the wreckage of the crash, to write it all down as doctrine, which is how you get a theory that is simultaneously famous for one spectacular call and unfalsifiable enough that people are still fighting about it a century later. The most celebrated moment in its history was published by a man who died before he could be asked a single follow-up question. Let me bring this back to you, and to that sentence on the evening news. Charles Dow built a measuring instrument. That was the intention. He wanted a way to describe the general condition of the market so that his readers were not stuck with a list of prices and a shrug. But something happens to a measuring instrument once enough people watch it. It stops being outside the thing it measures. When money began to be managed against indexes, when a fund's job became tracking a benchmark, and a manager's performance became a comparison to a line, the index stopped being a description of the market and started being an instruction to it. Being added to a major index means being bought by a great many funds because they are required to hold it. Being removed means being sold for the same reason. The company has not changed on the day of the announcement. Its inclusion in a list has changed. That is the moment a thermometer starts changing the temperature. And Dow's specific creation carries an additional oddity into that role because of the price weighting we walked through. A single high-priced stock can swing the most quoted number in the world more than a company many times its size. So on any given evening, the sentence, "the market was up today," can be substantially the story of one or two share prices, sitting in a container assembled in 1896 for reasons of data availability that stopped applying a century ago. None of which makes the Dow useless. It is the longest continuous record we have, and continuity has real value. You can ask questions of a line that reaches back to 1896 that you cannot ask of anything else. But it does mean the honest version of that evening sentence is longer than the one you get. Not, "the market was up." That is less satisfying. It is also true, and I think Dow would have preferred the true one. Everything we know about how he ran a newsroom says he would rather print a longer, accurate sentence than a short one that flattered the reader. So here is what I want to leave you with. The next time you hear that number, remember what it actually is. It is not the market. It is a ruler built by a journalist in a basement on Wall Street using the only data he could reliably gather every day, a ruler that has outlived every company it originally measured. And when you meet a theory with a confident name attached to it, ask the question that this episode is really about. Did that person write this? Or did admirers assemble it afterwards, in good faith, filling the gaps with their own judgment until the hedges wore off and the numbered principles appeared? Because Charles Dow's most useful idea was never the index and never the theory. It was the standard he ran his newsroom by. Say what you can verify. Name your source. And when you do not know, say that you do not know. He built the number so that people would stop guessing. It would have amused him, and probably annoyed him, that his own name ended up on the biggest guess of all. Next week on The Toolmakers, we go to a man who did write his own rules down. Every one of them, by hand, with a mechanical calculator in New Mexico. Wells Wilder was a land developer and a mechanical engineer before he ever traded anything, and in 1978 he published a book containing formulas that are now built into essentially every trading screen on Earth. The Relative Strength Index. Average true range. And here's the question we are going to ask. He gave those formulas specific numbers, a 14-day setting a 70, and a 30. Those numbers are still the defaults on your screen today, nearly 50 years later. Where did they come from? And has anyone actually checked? That is next week. If this one was useful, follow the channel so the next one finds you.